So Tesla versus Nvidia. One of these companies is probably a bubble and it's going to crash. One of the companies is probably not a bubble and it's probably going to continue to moon going into the future. So which one is it going to be, Tesla or Nvidia? So in this video right here, I'm going to do a deep dive on Tesla and Nvidia, and you're going to be able to walk away from this video knowing what company should you invest in right now, which one should you maybe stay away from. So let's break down both of these companies side by side. We're going to do price targets, actual intrinsic values of these companies, and look at the true valuation of the company to really know which one should we invest in right now. So let's take a look at Tesla's chart here super quick. So this right here is a 6-month chart of Tesla, and you can see the 6-month return right here is 118%. The stock is absolutely mooning. Pretty much right after Trump got elected, Trump and Elon pretty much became like best buds, it seems like. And the stock has pretty much went euphoric since then. 118%, pretty crazy. If we look at Nvidia though in the last 6 months, Nvidia's only up 11%. So it's a very interesting divide between Tesla and Nvidia. So we're going to go through why that is happening. Is it justified? Maybe Nvidia appears to be cheap because it didn't go up as much. Maybe Tesla's expensive, or maybe the reverse. Let's break it down right now. So we're going to go through Charles Schwab right now. Tesla is going to be on the left for all the columns, and Nvidia is going to be on the right. So just looking at the charts, here's a 6-month chart right here. Tesla is going to be the blue line, totally dominating Nvidia, but that doesn't necessarily mean it's a good thing. I mean, of course, I'm making a bunch of money on Tesla, but how much more room does Tesla have to go higher? Let's break it down right now. So scrolling down a little bit right here, you can see the net profit margin on Nvidia is way higher than Tesla. Nvidia is up here at 55%. Totally crazy. They're basically printing money over there. Earnings per share we're going to dive into in a little bit. We're going to go through my intrinsic value calculator here, and we're basically going to plug in Tesla and Nvidia, and it's going to spit out a price right here of what the true intrinsic value of these companies are worth. We're going to go into that in just a second. So price earnings ratio for the trailing 12 months for Nvidia is roughly 53. Tesla is 118. So Tesla's valuation strictly based off of the PE ratio, it is valued double the valuation of what Nvidia is on a price earnings ratio basis. So that does make Tesla look a little bit expensive versus Nvidia just on that metric right there. So the sales growth of Tesla in the last 1 year was 1%. Nvidia is 152%. So Tesla is more expensive on a valuation basis, but it's growing revenue even lower. That's something to think about right there. And then if we go right here, this is the earnings per share growth. So this is 1 year, year over year on a trailing 12-month basis. So basically last year versus this year, what was the earnings growth of the companies? So Tesla grew their earnings at roughly 17%. Nvidia grew their earnings at roughly 235%. Absolutely blowing Tesla away. And what I try to tell you guys all the time is the number one thing that moves the price of a stock in the long run is what the earnings growth of these companies do. If their earnings don't go up, it's hard for the stock to go up. It all comes down to what the earnings growth of these companies do. So this is another win for Nvidia. Nvidia is winning on sales growth. It's beating on earnings per share growth. It's beating on a valuation standpoint. The PE ratio is lower up here. So it's not looking good for Tesla right now, but there is going to be a couple surprises here in a minute about Tesla. So one thing that we do have to talk about right here is the earnings per share growth for the next 3 to 5 years. This is extremely important, and I do feel like this data right here saying 2.6% earnings per share growth year over year for the next 3 to 5 years for Tesla is a lot lower than what's actually going to happen. Of course, nobody knows what a company is going to do year 3, 4, and 5 from right now. These are just estimations right here. But if Tesla comes out with full self-driving, unsupervised, and a robotaxi network comes out, which I personally have a Tesla and I test it every single day, I think that it's definitely going to be rolled out next year, if not the year after that, in a mainstream way. If that truly comes out, I think that will be big for earnings per share growth, but I don't think it's going to be as big as what people think, but I definitely think it's going to be a lot higher than 2%. But basically, we're going to figure out how much more money Tesla's going to make on the autonomous cars, divide that by the total number of shares. So profit divided by total number of shares. We're going to get the profit per share, which is earnings per share. And then maybe we'll assign Tesla like a 40 to a 50 PE ratio. And that is going to be how much more value full self-driving robotaxi network is going to add to Tesla's share value. So we're going to do that in just a minute. But I do feel like this is low. We're going to factor in a number here because when we go to the intrinsic value calculator, we do have to do a growth rate for the next 5 years. So we will do that at a higher rate than this. And then for Nvidia, they're projecting 62% annualized per year. I do think that's possible, but the problem with Nvidia is the market cap you could see right here, it's over $3.3 trillion. So Nvidia is kind of going into the law of large numbers where as you get big, it's going to be harder to continue to grow even bigger. I feel like this AI revolution is literally just getting started. So Nvidia, in my opinion, and Tesla are still at the beginning phases of what they're actually going to be realized for the total market cap years in the future. But now let's look at a report here at Tesla super quick just to get a basis of what they're really doing with the company. So if we look at earnings per share, so this whole section right up here is earnings per share. This is quarterly, this is annually. So you could see right here, Tesla had a lot of earnings per share growth, 2020, 2021, 2022, and 2023. So if we go to Tesla stock on a 5-year basis, that corresponds with this pump right here where they went from roughly $29 all the way up to $407. So that is what I'm trying to tell you guys, that when you're growing earnings from 21 cents and you go to $4, that is a massive bump in earnings per share, and the stock price is probably going to follow. But you could see right here, 2024 estimated. So Tesla already reported Q1, Q2, and Q3. We're expected to get Q4, but that's going to come to the end of January, which is what it says right here also. So actually, Tesla's earnings per share growth is not going to be any growth. It's actually going to be negative this year because 2023, they were $4.30 per share. 2024, they're going to be $2.48 per share. But the problem is Tesla's earnings per share is going down, but the stock price is going up. So typically stocks will follow what the earnings of the companies do, but Tesla is not. So that in my head is a little bit of a red flag for Tesla. Again, I feel like Tesla should be down right now from 2023, but it's actually up quite a bit. If we look at the chart of Tesla, look at what it was trading for in 2023. So if we just go to the end of 2023 just to get like an apples for apples, it was roughly $2.50 per share, and right now we're $4.30 per share. So Tesla's up almost a double, but the earnings per share is down almost half. So it's very interesting what's going on with Tesla right now. Usually the stock market is forward looking roughly 1 year. So whatever their earnings are expected to be 1 year from right now, the stock market will bring those earnings back to the current price right now, and it'll value that into the company right now, and then that'll make the stock price be reflective of the earnings 1 year from right now. But Tesla right now, I feel like it's pulling earnings from like 4 or 5 years in the future to right now. So the stock trading at these levels right now of like $431 per share, it's pretty much pricing in perfection. And in just a second, like I said, we're going to go through what FSD is going to add to the valuation of Tesla. But really, like the whole valuation of Tesla is going to be built on FSD and Optimus robot, in my opinion. But Optimus is like 5 years beyond in the future, and FSD is the next big thing to come. So really the local valuation of Tesla in the next 5 years is really all going to be FSD, but we're going to price that out in just a second. I don't want to bore you guys too much, but I just want you to understand stock price is going up, earnings are going down. That's a red flag. That's why the P ratio is going up. Tesla is becoming more expensive. Also look at the revenue growth. 96 billion last year, 99 billion this year. Not much revenue growth. So that is another red flag for Tesla. So I'm going to end on Tesla right there. We're going to come back to it in just a second. Nvidia, I just want to do it as a comparison. Look at Nvidia's growth. Look at their revenue growth. 16 billion, 26, flat. Then the 60, so over a double. And then the 129, a double again. So Nvidia is growing revenue like crazy. They're growing earnings like crazy. But the stock in the last 6 months is flat. So I talk about in my course all the time this rubber band analogy. Stocks will usually follow what the earnings growth of these companies do in the long run. So as Nvidia's earnings are going up, but the stock price is staying flat, the stock is actually becoming cheaper because the earnings are going up. The stock should follow earnings, but it's not following earnings. So the stock is kind of like sprung down, ready to spring back up, in my opinion. I know it sounds very basic to say it like that, but really like that's called reversion to the mean. Stocks will typically follow earnings. Tesla's way above the earnings growth line, so Tesla's probably going to do a correction lower, which it did have a blow off top. If we look right here, if we go to, what do we go to, like a 1 month chart right here, you can see Tesla was 480, now it's 430, so it did blow off. Nobody knows how low it's going to go, but honestly, if you told me Tesla was going to be half the price in a year from right now, I would honestly believe you. And if Nvidia was double a year from now, I would believe you too. But let's do this. Let's head over to my intrinsic value calculator. If we type in Nvidia right here, I have this pre-programmed to load up right here. If you want this calculator for free, I'll have the link below in this video, by the way. So let's figure out what their earnings per share of Nvidia was. So if we go to Schwab, we look at earnings per share, let's just take $2.95 as the earnings per share for 2025. I know they still have to report Q4 2025, and I know it's 2024 right now. Nvidia pulled their fiscal year forward by roughly a year. It's confusing and I think it's stupid, but they did it that way. That's how some companies do it. So be aware of that. So the earnings per share for Nvidia for the trailing 12 months, which is fiscal year 2025, is going to be expected to be $2.95 per share. So if we plug in $2.95 right here, we have that. So this is a constant right here. We're not going to change this or this or this. But what we will do is change the current yield of AAA bonds. Right now, they're 5.14%. I just checked that, so that's what we'll put in for that. But the growth rate right here is what we are going to go through. But according to Schwab right here, they are expecting Nvidia to grow at 62% for the next 5 years. That also will be stated right here, long-term growth 62%. Now, is that possible? Of course. So what I'm going to do is plug in 50% right here just to have a little bit more margin of safety built into this valuation for Nvidia. So $2.95 per share, this is good, 50% growth rate, this is good, and this is good. The intrinsic value of Nvidia right now is $143 per share. It's currently trading at $137. So Nvidia is trading below intrinsic value right now. So if I want to buy Nvidia right now, I like to buy 15% below intrinsic value, currently trading at $122 per share. And the current price is $137. So it is a little bit, tiny bit above my target to buy it. But if I go here and I just put in 55%, but now you're going to see right here, it's pretty much current price at what my acceptable buy price is. So you could be buying Nvidia right now if you believe in these assumptions that I made right here. And on top of that, let's do Tesla just to show you how expensive Tesla looks with this calculator. So Tesla earnings per share trailing 12 months is going to be $2.48. So let's plug in 248 right here, enter. Now here's where the magic comes in. What do we think that Tesla is going to grow at in the next 5 years? Some people are going to say 5%, some people are going to say 200%. Me personally, I'm going to assume a 50% growth rate in Tesla for the next 5 years. I could be totally wrong. 5 years is a long time, especially when they're coming out with full self-driving, the robotaxi network, Optimus, new cars coming out, energy storage, all that stuff. But if we assume a 50% growth rate for Tesla in the long run for 5 years, the intrinsic value of Tesla is going to come out to $121 per share. It's currently at $431. That is showing you how expensive Tesla is right now on an earnings per share basis with all this stuff factored in. So the question is like, what does Tesla have to do to justify their valuation right now? So let's say we plug in a 200% earnings per share growth. If we plug in 200%, that is 200% every single year for the next 5 years, which is astronomical. I pretty much can guarantee you this is not going to happen. Then Tesla's valuation right now would be justified. So I am not a buyer of Tesla right now, even though I have 500 shares of Tesla in my Charles Schwab account. I made a bunch of money. But guess what I'm doing right now on my Tesla shares? I am selling covered calls. I think that Tesla is expensive. If I happen to go into money on my covered calls that I'm selling, I might just get rid of my shares. I mean, Tesla's lofty right now. I do know that they're coming out with some big stuff going into the future, but they have to make that so mainstream in order for that to materially affect the bottom line. All right, so let's work through some numbers right here to figure out how much money, if Tesla converts half of their current fleet to FSD, charging $300 a month, is that going to add to the bottom line? So Tesla right now sold roughly 7 million cars since they started making cars. If we assume half of those cars convert to FSD, the robotaxi network, that's going to be 3.5 million cars that bought FSD. So if we say 3.5 million cars times $300 per month, that is going to generate roughly $1 billion per month in revenue for Tesla from FSD. So if we multiply that by 12, you're going to get $12 billion per year. So $12 billion per year in revenue is what we could expect if Tesla has half their fleet at $300 a month convert. So that sounds like a lot of money, and of course that is a crap ton of money. But Tesla has a total of 3.2 billion shares outstanding right now. So now what we need to do is calculate the earnings per share that this is going to do for it. So we're going to do $12 billion, and we're going to divide that by 3.2 billion shares. That's going to be roughly $4 of earnings per share that's going to add to the bottom line right there on Tesla. So now what we got to do is assign a PE ratio, because this is the E part of the PE ratio. These are the earnings, but what is the price? How much money are you going to pay for those earnings? and that is what the PE ratio is. So Tesla right now is trading over 100 for a PE ratio, but as Tesla starts to mature, the company is going to go down in PE ratio. Pretty much any company as they mature, the PE ratio valuation will go lower. But let's just assume a PE ratio of 50. So then if we do equal sum right here, I mean, I don't even have to do it because this is basic math, but if we do that and we multiply it by this right here, so this is essentially what the value on a per share basis, having half of their fleet at $300 a month through FSD, it's going to be roughly $197 to the share price. That's $200. Tesla right now is trading for $431. So you have to figure out how much of the valuation of Tesla right now has FSD built into it, and how much of Tesla's valuation or stock price right here is just a company of selling cars, doing energy deployment and stuff like that. So I think Tesla is lofty. I think it's expensive. And I think these assumptions that I made right here are extremely generous. I don't think that Tesla's going to convert half their fleet next year or even a year after that. They probably will get $300 a month. I mean, I would pay $300 a month for sure. And of course, this number could be higher. Maybe I'm undershooting this a little bit. Maybe they'll convert a third of their fleet, but they're going to charge $1,000 a month, whatever it may be. But even at that, intrinsic value right now is 155. Add another 200 to it, that's going to put us at 355. Still expensive. I am not a buyer of Tesla at these values right here. I might consider selling my shares if I go in the money on the calls that I sold, but I think the move right now is to look at Nvidia. I think Nvidia is trading at a higher profit margin, higher earnings growth, higher revenue growth. The company pretty much has no competition. I really like Nvidia for the long run. I sold a bunch of puts on it. If I go in the money on my puts, I'll gladly take assignment of those shares. Just this month alone, I generated like $35,000 in put premiums by selling puts on Nvidia. I like Nvidia for the long run. I don't like Tesla as much, even though I think it's a sweet company. I love Elon, all that stuff, but the valuation is too stretched. So I know this was a little bit longer video, and thank you guys for sticking around if you made it this far. If you want to get my course, how I do all this stuff, how I trade options, how I make $30K a month doing this stuff, click the link below. It's on sale right now. The sale's not going to last forever.